Greetings, folks. This is Tyler Mordy, President and CIO of Forstrong Global, and we're delighted to bring you a short investing update. Obviously, a very interesting year out there in markets, and we wanted to share some of the risks and the opportunities and the outlook very briefly here. So, obviously, the one big concern out there is the end of cycle. That we've been hearing calls for an end of cycle rather. And this chart shows that we're at the longest business cycle on record in the United States. We're now at 131 months. And where we look at this, and we've written a lot about in the past, is that since 2009, we've been sort of focused on periods after financial crises and what they look like. And this one has been no different. We had the major financial crisis in 2008. And we since '09, we've said that expect there to be a very, very long recovery. Expect it to be shallow, expect it to be very different than your typical post-war recovery. And I think that has borne out in the data and borne out in our experience here. And we've seen the sort of the crisis morph. We've had this sort of EU sovereign debt crisis. We had a big commodity rollover, particularly impacting us at home here, invested in domestic equities. And so you can sort of characterize the market as sort of a start market. Many economies around the world have only started for their economic engines to start rolling around 2013. That's true of Europe, that's true of emerging markets, and several markets around the world. So the key point is that we don't expect an end of cycle, although it's obviously later stages. We don't expect an imminent end of cycle here, simply because these things tend to last a long time. And if you compare it, where we're hearing a lot of comparisons to 2007, if you compare it to that period, it's not even close in terms of how the current climate looks like. Back then in '07, we had obviously a massive asset, U.S. housing, that was inflated by all sorts of credit. And we had the Fed, who had hiked 500 basis points. And of course, in that environment, you're going to get a big correction. Again, this post-crisis recovery has been very shallow. The economic recovery has not been that large compared to others, even though the duration is longer. And so we think it still has some legs, and the Fed's only hiked about 200 basis points. I think not only the Fed, but central banks around the world are very committed to this cautious approach, this gradualist approach that we've heard central bankers talk about. So next slide, obviously the second big concern that I'll talk today quickly about is trade wars. And this is one of my favorite charts, but it's becoming clear that contrary to the Trump's administration, the trade wars are good and easy to win. They're neither good nor they're easy to win. I think what's happening is that corporations and CEOs and business around the world is giving a bit of an education on globalized supply chains, and the biggest loser in all of this will end up being the U.S. consumer and profit margins in the United States. And so it's important to keep your eye on the ball here in terms of where these things go. In the post-crisis period, we've had a variety of different rolling crises. I mentioned the EU sovereign debt crisis. There was North Korea. There was the variety of different transient macro scares and headline risks that really didn't materialize. So this chart is interesting in the sense that it shows the ratio of emerging market currency volatility relative to developed market currency volatility. And you can see it spiking in late 2002, in late 2008, and again in the fall of 2018 here. And all of those periods led to massive rallies in international assets led by the emerging markets. And so if sort of past this prologue here, we can anticipate that there should be some good returns ahead, just because simply these volatility spikes don't last. We think there's been a lot of indiscriminate sell-offs in a wide variety of emerging market assets, both the debt markets and the equity markets, and we're positioned for that. Lastly, on these slides, really important setup right now. In the United States, we have a situation where we've had tax cuts, we've had fiscal stimulus, the economy is obviously ripping. We think it slows down next year. And in this environment, we have the most favorable outlook for U.S. corporate profits on record. Compared to the United States, we've got global emerging markets and a lot of international markets with extremely low expectations for corporate profits. So we think it's a very important setup, but we think it's one of the best opportunities since 2008 to move out of the United States. And again, because we don't think it's end of cycle, that doesn't mean that the United States is going to underperform or roll over into negative territory. We just think it's going to underperform. But we think, if you look at one region that has high expectations and high valuations, and you look at another region, namely in a lot of these international assets that have low expectations and low valuations, it's a pretty important and significant opportunity for global asset allocators to rotate into those asset classes. And we have positioned for that. We've positioned that this year. And somewhat stealthily, the emerging markets have actually been outperforming since mid-September. That's not a well-known fact, but particularly in the bond market, has been really outperforming. So we think that if you're running global investment portfolios as we do, then that's an important asset mix opportunity to get right. And all the data points, both on the valuation, the expectations, the behavioral side, are pointing that one should be positioned there. And just a reminder that this is our moderate core portfolio, and just a reminder that we do have steady performance at Forstrong despite these periods of volatility. This chart just shows the maximum drawdown during the year and then the full calendar year return. So remarkably, in 2009 we were down 8.6% at one point in the year, and we ended up at 18.3% that year, just as an example. So you can see a very wide dispersion to what happens intra-year and then your full calendar year return, and that's sort of a emblematic, if you will, of our style. We're always well diversified, and opportunities like the ones that I've just talked about, shifting into international markets and emerging markets, you have to be there before the trend occurs, and oftentimes that results in some short-term underperformance, but nothing disastrous. And then lastly here, just on the chart, just a reminder of our performance. This firm was built, to avoid those big mistakes that we'd always talk about in investor portfolios. And we're just showing 3 of our portfolios here, just the global ones, including the special opportunities focus. We're showing those periods where investors could have made the big mistakes, like the global financial crisis in 2008. That's sort of the flagship one, if you will. But we also saw 2011 was a tough year. I remember August very, very well of that year, and the EU was supposed to break up, and that's sort of, again, been a feature of the post-crisis landscape, that we continue to see these tail risks, not to minimize the gravity of the situations that they occur, but the tail risks just throw up opportunities instead of creating permanent capital losses. And of course, the 2015 commodity bear market, which was tough on folks that had a strong home bias. But we endeavor to provide exposures to investors that are global in nature and don't necessarily move with just the fortunes of the Canadian stock market. So that's a quick update. Thanks for your continued support and confidence in the firm and our staff. And we'll look to give you a short update here soon as well. Thanks so much.